Dear students, welcome you all for the session. I am Dr. Dinesh, Assistant Professor, School of Management, Shastra Devi University, Tanjavur. In this session, I am going to discuss about the financial markets. In the previous unit, you all studied about the Indian financial system. So, the Indian financial system comprising of financial instruments, financial institutions, financial services and financial markets. So what is financial markets? So the financial market is a place where the financial instruments are traded. So different types of financial instruments are being traded in the market. We call it as financial market. So which helps the firms, which helps the government for mobilization of funds in the market. It helps the household to make investment of funds into the market. So like the circular flow of income, it happens in this market. So whoever wants to save, whoever wants to make investment into the market, it has been facilitated through the financial market. The similar way who wants to get the funds from the market, either it is for the short requirement or a long requirement, can we get the fund from the market. So this is a base for the financial market. We have a discussion in further on this call it as financial market, where the financial market is divided into the two major segments. We call it as the capital market and money market segments. So what is capital market segment and what is money market segment? The capital market is a place where the long-term instruments are being issued. The long-term requirement of the enterprises can be mobilized through this particular market by issuing shares, debentures and bonds. The similar way, the money market, which helps the enterprises, the government, for mobilizing of short-term requirements in the market, which we call it as a money market. So there are different instruments are being issued in the capital market as well as the different instruments are issued under the money market. It is being issued by the companies, it is issued by the banks, financial institutions, issued by the government for fulfilling of their obligations. Either the obligation may be a short-term obligation or a long-term obligations. So the long-term obligation, say for example of a long-term obligations of an organization, that the funds may be required for the organization for meeting out the long-term requirements. So what may be the long-term requirements? It may be like the expansion of the organization, diversification into some other field, launching of new product. There may be the different reason the fund is required for the organization. So those fund requirement is not like a short requirement, it is like a long requirement. It may be for a 10 years of time period, 20 years of time period, maybe a permanent capital is needed from the market. So that can be collected from the market by the enterprises by issuing of capital instruments. It is like they are issuing like the equity shares or issuing preference capital or issuing debentures in the market. Similar way, if the government wants to mobilize the fund for the long-term requirement, the governments are also issuing, or the public sector enterprises are issuing the bonds in the market. So this might happen in the capital market, depends upon the requirement of different entities in the market. The similar way, like the money market, which going to provide the solution for the short requirement, fulfilling the short-term obligations of the enterprises, short-term obligations of the government, it can be fulfilled through the money market. So different types of money market instruments are being issued in the market. It's like the treasury bills, certificate of deposit, commercial papers and repos. So like that similar type of instruments are issued. Like a treasury bill you can take is issued by the government or on behalf of the government, the Reserve Bank is issuing the treasury bills. So the treasury bills are going to fulfill the obligations of the government, short-term obligations of the government. So normally the treasury bills are issued for a period maximum of 1 year. It's like the 364-day treasury bill is the maximum denomination is issued by the government. And can say it is like issued at the discount rate and redeemed at the par rate. It means the instrument doesn't have any explicit rate of return. You know that it is like a debenture. It is being mentioned as 8% of debenture, 10% of debenture, 11% of debenture, 11% of preference capital or preference shares. That the investor can understand about from the instrument itself, they understand, can get the interest rate of 8%, can get the interest rate of 10%, can get the interest rate of 11% on that the instrument. From the instrument they are receiving. So the title of the instrument itself, the interest is being mentioned. It is explicitly available. That they call it as explicit interest rate. Whereas the implicit interest rate, it is being issued at the discount rate and redeemed at the par rate. It means, for example, the 110 rupee worth of or the par value of instrument is being issued in the market for 100 rupees. At the time of maturity, it will be redeemed at 110 rupees. So you know you are going to buy the particular instrument for 100 rupee, but the real value of that instrument is 110 rupee. The issuer who has issued that particular instrument will be redeemed that instrument for 110 rupee after certain period of time. Let's say for example, after 1 year they will redeem at 110 rupee. So what the benefit is going to be realized by the investor for making such investment into such instrument? Can say the 10 rupee is a benefit. So this 10 rupee is going to be the benefit realized by the investor. It is not explicitly mentioned on that particular instrument. So I can say it is like the 10 rupee, the purchasing price of the instrument is 100 rupee. So 10 divided by 100, you might get the 10% of return from that particular instrument. But it is not mentioned in the title of the instrument and it does tend to change according to the market condition. So that is what the important characteristics of implicit interest rate. It is normally issued at the discount rate and will redeemed at the par rate. It depends on the market. It depends on the market requirement. The rates are tend to change. So this is the basic characteristics that are applicable for the treasury bills. So the treasury bills normally issued with the denomination of 91 day, 182 days, 364 days, maximum 273 days, like the denomination in which the instruments are issued. Instruments are issued in the discount rate and will redeemed at the par rate. Are the basic characteristics of treasury bill. You know that the treasury bills are issued by the government. On behalf of the government, the Reserve Bank is issuing the treasury bills. So it is for fulfilling of short-term obligations of the government. Second important aspect, this treasury bill is considered as the risk-free instrument. Why this treasury bill is considered as a risk-free instrument? Because this instrument is issued by the government. So the government is issuing such kind of instruments considered as a and this instrument is free from the risk, free from the default risk. So whatever the situation, whatever the crisis may happen, downfall of economy may happen, the government will pay. Even the government may not be able to pay such amount. The government have an autonomy to print the currency notes and to repay such amount might be possible. So this is considered as a zero risk involved with this kind of instrument. So this we call it as the risk-free instrument. Otherwise, or technically or statistically, we can say this instrument we consider as a zero beta. You please understand that the beta is a measurement of risk. Beta is a measurement of systematic risk. So you know that the instrument and the market entirely is different. Based on the instrument, the market performance will be determined. So whatever the changes happens to the instrument, it means the particular securities. So you understand the meaning of securities, financial securities, shares, debentures, bonds together as a securities. Shares, debentures and bonds together as a securities. So based on the security price, the market price will be determined. So similar to this, whatever the changes happens to the security and whatever the changes happens to the corresponding market, so the risk is being measured by using the concept, using the statistical tool, we call it as beta. So it is considered as a zero beta, the treasury bill is considered as a zero beta. It means there is no risk is associated with this instrument. So normally when we are going for the calculation, we are taking the zero risk. It means a zero beta. Might obviously we have taken the rate in which the treasury bills are available in the market. So this is one important aspect related to the treasury bills. Similar we have the certificate of deposits, commercial paper. So the certificate of deposits are also packed with the assets are being issued in the market. It is short-term requirement of the enterprises, financial institutions, banks can issue the certificate of deposits. The commercial paper is another one important aspect. In the commercial papers, it's like a promissory note. It isn't packed with any assets. It is being issued in the market like the uncollateral based instrument. It is being issued in the market. So we call it as based on the promise made by the enterprises, based on the promise made by the banks and financial institutions. The investors are making investment into such commercial papers. Similar way, the repo agreements, repossession agreements, including like have the call money interbank financial transactions are together as a part of money market instruments. So the money market instruments, it is like treasury bills, certificate of deposit, commercial papers and repos. Similar way, the capital market instruments, equity shares, preference capital, debentures and bonds together in the capital market. So these are the instruments are traded in the capital market segment and money market segment. And we'll have the further classification of capital market into a two major category. It is primary market and secondary market. So what is primary market and what is secondary market? So the primary market is a place where the fresh issue of securities are happen or fresh issuance of securities are going to happen in the primary market. If the company wants to mobilize the capital, either in the form of preference capital or equity capital or a debt capital, they can be able to mobilize from the market. The fresh issuance of securities that happens in the market, we call it as primary market. The primary market is otherwise called it as new issue market. New issuance of securities that happens in the market, we call it as new issue market. So this is the primary market. So you know about the primary market, only about the fresh issuance of securities that happens in the market. The second important aspect, the secondary market. The secondary market is a place where the securities which are already issued in the primary market can again bought and sold in the market. We call it as a secondary market. Understand? The instrument which are already issued in the primary market. So the primary market we can't able to sell the securities, again buy the securities between the investors may not be possible in the primary market. So the secondary market is exclusively developed for the purpose of marketing of such securities, buying and selling of securities in the market. So which we call it as the secondary market. The secondary market is otherwise called it as a stock market. So entire stock market activities are being carried out by the stock exchanges. So the stock exchanges is an autonomous institution who are carrying out the buying and selling of securities on behalf of the investors. The entire execution of trading, settlement, everything, the platform is being provided by the stock exchanges. Can trace the origin of stock exchanges in India. It was started in the period of 18th century itself. As a Bombay native trading, the concept of the stock exchanges. Before that, they have used the system of open outcry system. It's a manual system of selling securities in the market. Where after the development of technology in the market, during the 19th century, it was like the different stock exchanges are established for enabling the technology into the market. So we have 23 stock exchanges in India, 19 stock exchanges or regional level stock exchanges like Calcutta Stock Exchange, Madras Stock Exchange, similar. Remaining 4 major stock exchanges are there in India. It is Bombay Stock Exchange, National Stock Exchange, Interconnected Stock Exchange, Over-the-Counter Exchange of India, or the major stock exchanges. So once again, the major stock exchanges in India: Bombay Stock Exchange, India Limited; National Stock Exchange, India Limited; Interconnected Stock Exchange, India Limited; Over-the-Counter Exchange, India Limited, or the major stock exchanges in India. So what may happen to the remaining 19 regional level stock exchanges? It was started, now they are doing the functions of Bombay Stock Exchange and National Stock Exchange. They are assisting for the Bombay Stock Exchange and National Stock Exchanges. So this is what the importance that we have the stock exchange. Primarily the stock exchange was established for the purpose of making or facilitating the trading in the market, and it is a market. It was created as a market for secondary securities. It means secondary issuance of securities. It is already issued in the primary market, which can bought and sold in the market. Further, the market facilitation has been done as a secondary market. So in that, there are technologies are being introduced over the period of time. Currently what we have, the different stock exchanges are offering different platforms. Like a National Stock Exchange you can take, they offer the NEAT, National Electronic Automated Trading. Similarly, the BSE offering Plot, Bombay Limit Order Trading. It's like they are offering such services through online. So the investor can buy and sell the securities through online. Screen-based trading is enabled. They can quote the price, they can buy the securities, everything. But how the transfer of securities is going to happen? Because the instrument what I am going to deal with is a capital instrument. It is like a shares, debentures, I am going to buy it from the market. So it is result in transfer of securities. It is result in transfer of property. How it does going to make result? So it is not only the stock exchanges, there are number of associate institutes are going to be associated for this particular process. So when we have open outcry system, it's a manual system for selling of securities, buying of securities in the market. It was replaced with the limit order trading or screen based trading system. Then all the physical certificates, physical share certificates are converted into the digital certificates. So this process we call it as a dematerialization. Converting of physical certificates into a digital certificates. Call it as dematerialization. So this process is going to be facilitated by the depositories in India. So the role of depository is going to convert the physical certificates into a digital certificates. As well as if any investor wants to convert their digital form of certificate into a physical form of certificate are also done by the depositories. The process we call it as rematerialization. So either a dematerialization or rematerialization are under the control of depositories, and the depositories are going to play a vital role for this conversion process. Almost they have completed 98% of physical certificates have been converted into a digital certificates in India. And you can take how many number of depositories that we have in India. We have two major depositories, call it as NSDL and CDSL. National Securities Depository Limited and Central Depository Service India Limited are the major depositories who are converting the process, who are involving the process of digital transformation in the process of certification, in the process of digital SAT certificates are being provided, and it is being stored in an account. We call it as DMAT account. So this particular process involved for the transfer of securities, conversion of the physical certificate into the digital certificates. And there are institutions who are associated with the clearing and settlement process. So if I am a buyer, there is another seller, I have quoted a price. In this particular price, the investor is ready to buy my shares, which I was owned already. So what may happen in that? It is like a process is going to happen. I am going to transfer the securities, or I am going to sell the securities to another investor. So the another investor is going to buy it. So they might pay the amount for that. Now they are making investment. I am going to receive that particular investment. I am going to get back my investment into the market. So I need a money, and that investor needs the transfer of certificates is going to be done by the clearing corporations primarily involved with this process. Like we have NSCCL, National Securities Clearing Corporation Limited. They are involving with the process of clearing and settlement process. So like the institutions who are supporting in the stock market, in the stock exchanges. And another important aspect related to this stock exchanges or stock market, whenever the company is going to issue the capital, so you know in the new issue market, it is the companies are issuing fresh issuance of capital. How the fresh issuance of capitals happens in the new issue market? There are the different ways, different methods are to be adopted by the companies. So what recently it is mandated that either the company is going to issue the capital in the primary market also should be registered with the stock exchanges. Because once the issue it was happened in the primary market, allotment process is over in the primary market, then the investor wants to liquidate. Wherever the investor wants to liquidate their investment, they seek the helps of the secondary market. So it is mandated by the Securities Exchange Board of India. Prior to that, the institution who are going to, or the issuer who are going to issue the capital in the market, they should listing themselves into the stock exchanges. So there is a concept called listing of securities in the stock exchanges. So what is the concept of listing? Listing is an agreement between the issuer and the stock exchanges. So the issuer, the company who wants to issue the capital in the market for further mobilization of capital for their further enhancing their business activities. Either they are going for diversification or expanding their business organization, purchasing of new machineries, going for developing of new product. The different aspects the funds are needed for the organization. So they are approaching the capital market for mobilization of funds. Once they are approaching the capital market itself, they have to be listed into the stock exchanges. So that particular agreement has facilitating the enterprises to issue the securities in the market, which helps the investor to immediately get the benefit out of that. Immediately the marketability may happen for their securities which they bought from the primary market. So this is about the overview of financial market. So the financial market is a place where you are going to buy and sell the securities in the market. The financial market facilitates for the trading of financial instruments. Financial instruments are divided, it means like the financial market are divided into two major segments. We call it as the capital market segment and money market segment. The capital market segment, it means the instrument which are issued by the companies for mobilizing the long-term fund requirement, whereas the money market for the short-term requirements of funds can be issued in the money market. The capital market is divided into two major categories, the classifications of the market, which we call it as the primary market and secondary market. The primary market, it is otherwise called it as new issue market. The new issuance of securities happens in the market, call it as the primary market. The secondary market is a place where already issued securities from the primary market is again bought and sold in the market, we call it as a secondary market. The secondary market is otherwise called it as a stock market. The entire stock market activities are carried out by an institution, we call it as a stock exchanges. The stock exchanges, there are about the 23 stock exchanges are there in India, but the major stock exchanges are like the Bombay Stock Exchange, National Stock Exchange, Interconnected Stock Exchange and Over-the-Counter Exchange of India Limited are like a major stock exchanges in India. So this is about the overview of financial market. So let's start with the first one, the capital market. What we call it as the capital market, how the two different segments call it as the primary market. The primary market is otherwise called it as a new issue market, whereas the secondary market is otherwise called it as a stock market, or we call it as a stock exchanges. Activities are being carried out in the secondary market by the stock exchanges. And we'll take the functions of new issue market. What are the functions are being carried out under the new issue market? The first one, the transfer of resources from the saver to the entrepreneur issued by the new or existing companies, which can be the first one, first function of new issue market. So in this topic, functions of new issue market. Functions of new issue market. Transfer of resources from the saver to the entrepreneur. Saver, like a general public who wants to save the money for the future purpose. So they are going to make deposit of money into the banks and financial institutions. And like an entrepreneur, like enterprises, institutions who wants to mobilize the funds from the market, they are going to get the funds from the investors who are going to make investment. So this is going to be facilitated by the new issue market. Then the second important aspect, issued by the existing or new enterprises. So it is not only the new enterprises are going to issue the fresh issuance of securities. It is institutions, enterprises who already established. Already the enterprises has issued the capital. Again they can issue the capital. Again they can mobilize the capital in the market, can be possible. It is also facilitated by the new issue market. Determine the class of securities are to be issued. Shares, debentures, bonds. It's like a shares, preference capital or equity capital, or convertible, non-convertible, redeemable, irredeemable, participating, non-participating. The different class of assets, the different class of securities are being issued in the market. It is facilitated by the new issue market. And the price of such securities are accordingly fixed by the market condition. So there are a different process adopting the price in the way the securities are being issued in the market. It's like they have a process of book building while fixing the price for the securities. Evaluating the financial resources, financial capacity of the organization, the stand in which they are in the market, the financial conditions. So similar way can be analyzed about the capacity of the institution and net worth of the enterprises where the price of such securities are being issued, and what is the level of risk is associated with that particular instrument in the market. Relatively the prices are being fixed. Next important functions of new issue market. It gets the help from the underwriter for giving them the guarantee for subscribing the portion of capital. So normally you know the function of underwriter. So underwriter can help the enterprises in case of unsubscribed portion of capital. So you know that the minimum accordance to the norms of Securities Exchange Board of India, if the issuer is going to issue the capital, it's like equity capital they are going to issue in the market, it should be at least subscribed about 90%. They have received the capital, at least 90% of the capital what they have issued in the market. For example, if the company has issued the 500 crores of capital in the market, at least they need to secure 450 crores capital has to be received from the market. In the case of failure of such issuer, they have to return back the amount collected from the investor. It is going to be the tedious process for the issuer to return back the amount. There are the cost for mobilizing the capital is going to be the high. So that particular problem is going to be rectified by the underwriter. So they are going to subscribe the remaining portion of capital. It's like, say for example, 430 crores of capital is only collected. At least we need to have remaining 20 crores of capital, then only I can able to, as a issuer, I can able to retain the capital. So this particular process the underwriter will help. Underwriter will helping out to the issuer for this particular process. The underwriter is a firm, is going to invest on the companies, investing on the capital issued by the companies. It is especially for unsubscribed portion of capital can be subscribed by the underwriters with the agreement with the issuer. So they have a basic agreement between sort of the underwriting agreement. Maybe a hard underwriting or a soft underwriting or like the firm underwriting, partial underwriting or full underwriting. The concept in which they are going to involve with that particular agreement depends on that they will execute. So this process is also facilitated under the new issue market. The brokers and dealers are assured that they are attract to the investor to sell the securities. So they are facilitated for this particular process. So the stock exchanges are not directly involving on the buying and selling of securities. The stock exchanges appointing the trading members who are called it as a brokers. For example, Kotak Securities, ICICI Securities, Religare Securities, Integrated India Enterprises, Garvey Securities are like the major brokers in India who are going to deal with the stock exchanges on behalf of the investor, who are going to open the account, who are going to provide facilitating the account, which you are going to deal with that. So these are the major functions are done in the new issue market. The second important aspect, the methods of floating securities in the primary market. So you know primary market is a place the fresh issuance of securities are happen. How the fresh issuance of securities are happen in the primary market? There are different methods are available. We call it as the public offer, right issues, private placement and preferential allotment. So the public offer can divide it into two major categories. It is called it as initial public offer and further public offer. So what is initial public offer? Initial public offer, the first time the company is going to issue a large capital to the investor, general public. So the general public are going to subscribe the portion of capital for that particular company. We call it as initial public offering. At the very first time the company is going to issue the capital. See, say for example, it is not mandated that the new companies are only issuing the capital into the market, and that the function itself, you all know that it is not only for the new firms or the new enterprises, also for the existing enterprises can furtherly mobilize the capital in the market. Furtherly, they can issue the capital, it can be subscribed by the investor in the market, retail investor in the market. So, the second category of public offer, call it as the further public offering, FPO. So, the company has already issued the IPO. Again, the company is in need of fund for their further establishment, further expansion, diversification of their business activities. So, they are in need of funds. So again they can approach the market for further mobilization of funds, further mobilization of capital. We call it as further public offer. The second time or a third time or n number of times they can able to mobilize the capital from the market, stating the reason for getting the funds from the market being approved by the Securities Exchange Board of India. Then they can be able to collect the capital. Issuance of prospectus can be possible. So you know the prospectus is an invitation, official invitation that invite the capital from the investor. The second category is right issue. It's like the rights are given to the existing shareholders to subscribe the new portion of capital. So we have already the existing shareholders are there. We are giving the rights to the existing shareholders to subscribe the new portion of capital. So it is not going to diluting, like the control is not going to be the vast. The control is going to be the limit. Can be limiting the control. Can be taken the decision easily. So for that the companies are going for the right issue method. So the right issue method gives the rights to the existing shareholders to subscribe the new portion of capital which is available in that particular company. You take an example like the 500 crores of capital is already issued by the company. Again the company is going to issue additional 250 crores capital. So this 250 crores capital is given rights to the existing shareholders. It is like whoever already having 2 shares can able to buy additional 1 share. It is a right issue. So it doesn't mean that every shareholder needs to exercise that particular rights. It is not mandate. The majority of them, if they have agreed during the annual general meeting, they can go for the option of right issue. So if not fulfilled, again the underwriter is going to subscribe, or through the public offer they are going to issue the remaining shares. Can be possible. So you can take here the public offer and the right issue are the 2 important methods to provide or to mobilize the capital from the market. It is, we call it as retail issue. These issues are specifically for the retail investors. The next 2 is focusing on the institutional investment where the retail investors are not participating. Who are the retail investor? General public or the retail investor who wants to make investment, the small amount of investment they wants to make it in the market. So they can be able to invest into the public offer, they can be able to invest in the form of right issue, can be possible. Can take the next 2 private placements and preferential allotment or the institutional issues. If the issuer wants to mobilize the capital, it is like the short time period they wants to mobilize the capital. The sophisticated way of collecting the capital from the market is an institutional investment. There are few investments, it means the few institutions are participating in the investment process. Can take the private placement. It is like the companies which are unlisted. Either the company may be a private limited company or like firms are making investment into the company. It means your company is already a public limited company, your company is already listed into the stock exchanges. In your company, there are companies like the unlisted companies or like privately held companies are making investment into your company. We call it as a private placement. Like for example, your company is like ABC Limited. ABC Limited itself is a public limited company. It's like the other companies. It's like Godari Private Limited wants to make investment into your company. It is a private limited company wants to make invest in your company. It's a private placement. It's like a Sagar and Associates wants to make invest into your company. It's like a firm. They wants to make invest in your company. So it's like a private placement. And the preferential allotment is going to be given to the institutions, enterprises. It's like the enterprises which are already limited, public limited. Those institutions, listed companies are making investment into your company. We call it as preferential allotment. In your ABC Limited, if ICICI Prudential Asset Management Company is going to invest. This company is already a public limited company. This company is a listed company into the market. They want to make invest in your company. We call it as a preferential allotment. It's like the Reliance Nippon Life Insurance Company Limited wants to make in your company. So insurance company is a limited company, is a listed company into the stock exchange, wants to make invest on your company, is a preferential allotment. So like the qualified institutions, like for example of asset management companies, insurance companies, banks and financial institutions wants to make invest on your company, other public limited companies wants to make invest on your company, or comes under the category of preferential allotment. So you please understand that the methods of floating new issue of securities, the new issuance of securities can be done in the form of retail issue and institutional issue. Retail issue for the public are going to subscribe the capital which is required by the organization. Whereas the institutional issue, the required capital can be subscribed by the institution. Enterprises are subscribing the capital which is required for the company. So in that particular category of retail issue can be classified into two major categories, is a public offer and right issue. Unlike the institutional issues are classified into the private placement and preferential allotment. So the public offer again divided into initial public offering and further public offering. As a large, the company wants to mobilize the capital from the public, issuance of large capital from the public. Issuance of large equity shares is going to be subscribed by the investors to that particular company, public to that particular company. That we call it as public offer. Right issue, giving rights to the existing shareholders to subscribe the new portion of capital in that company. We call it as a right issue of capital. It's like a preferential allotment. The institutions, enterprises are going to make investment. It is like asset management companies. It is like the insurance companies are going to make invest on your company. That comes under the part of preferential allotment. And the private placement is going to be the privately held companies are going to make invest on your company. So these are the methods of floating new issuance of securities. Let's come to the part of stock market or secondary market. We call it as a stock exchanges. You know that the meaning of the stock market is the outstanding securities are traded in the market. Instrument is already being issued in the market. It's again bought and sold in the market. Call it as stock market. And facilitating for digital transaction of securities. So you know about 23 stock exchanges. Major stock exchanges are like Bombay Stock Exchange and National Stock Exchange. The Bombay Stock Exchange, which was established during the period of 18th century, that the Bombay Stock Exchange was established. They bring a kind of a system. They bring a kind of the trading system into the picture during the period 1996. Screen-based trading system was introduced by the Bombay Stock Exchange. Similar way, 1994, the National Stock Exchange was established, and they bring the National Electronic Automated Trade is a basic system brought it by the National Stock Exchange into the market. It is, we call it as both, collectively we call it as a screen-based trading system. Screen-based trading system which was used by Bombay Stock Exchange is called it as PLOT. PLOT is a Bombay Limit Order Trading. Automatic execution of transaction happens under the market. And electronic deliverance of securities, digitally transferring of securities, rolling and settlement, clearing and settlement happens in the market. So you know the clearing and settlement. If I am investor A, investor B, investor A is going to sell the security, investor B is going to buy the security. So the transfer of security from the investor A to B and from the investment is going to be get back. From the B to A, the settlement is going to be happen. Normally in the cash market segment, we have a time. It is like T plus 2 trading plus 2 days. After it's like the time for rolling and settlement which happens in the market. About to know about the basic functions of stock exchanges, you need to know about the functions of the National Stock Exchange. So you know it is the National Computerized Stock Exchange. To bring the technology into the picture, the Securities Exchange Board of India, the Government of India wants to establish such stock exchanges in India. It is a National Computerized Stock Exchange. Trading members are connected through the satellite. Virtual satellite VSAT is being used for this purpose, for connecting all the trading members to the terminal of stock exchange. And the NSE is using the order driven system. Based on the best buying order, based on the best selling order, that contract is executed. So investor wants to sell at what price? Investor wants to buy the security at what price? Based on the demand prevailing for such security, the pricing of such securities happens and the order is automatically executed in the market. And like all the trades or NSE, National Stock Exchange, is guaranteed through the NSCCL, National Securities Clearing Corporation Limited, is a clearing and settlement process is being enabled through this particular institution. NSE has two major segments. We call it as capital market segment and wholesale debt market segment. The capital market segment is like the equities and equity related instruments are being traded. Equity shares are being traded. It means the instrument is already issued, can be bought and sold in that market. Especially the capital market segment is going to be the part on this. The wholesale debt market, it is like the transactions between the government securities, public sector bonds, commercial papers and other debt instruments with a high value. So this is specifically for high value transactions which happens in the wholesale debt market segment. Like the similar way, in addition to that, the function done by the National Stock Exchange, the Bombay Stock Exchange also bring the kind of screen based trading system during the period 1996. And they are also following a kind of order driven system. The important concept, they call it as the security financing. So the security, the terminology you know about, it is the shares, debentures and bonds. The financing, mobilization of funds can be done in the form of issuance of securities. Issuance of shares can be the one major aspect of security financing. The second important aspect is issuance of debentures. So the issuance of shares in the form of preference shares or equity shares. So we take the preference shares and equity shares. What's the basic difference between this? Shares are the capital. It's a portion of capital. Either the nature of the instrument can be classified. According to the nature, we can classify either it may belongs to the preference capital or preference shares or equity shares. Can be classified accordingly. Okay. So that the forms of preference share can be issued either in the form of cumulative or non-cumulative or participating, non-participating, redeemable or irredeemable category.